Welcome, everyone. My name is Josh Weiss. I'm the head of sales for Utila. For anyone joining this webinar series for the first time, this is a monthly series that is hosted by Utila, which is focused on a variety of relevant topics across the broader stablecoin ecosystem. I think today's topic is especially timely. Over the last, say, 12 to 18 months or so, we've started to see much more regulatory clarity emerge globally around stablecoins and digital assets. I think it's clear that our industry is moving towards much more defined frameworks and expectations for any sort of companies operating in our industry. With that, I would say we're seeing a large shift institutionally. There's more traditional enterprises that are seriously evaluating how stablecoins fit into their products and infrastructure across a variety of use cases. And overall, I think everyone can agree that the bar around compliance is getting significantly higher. And today with the panel, we'll tackle really what this sort of means in practice. Super quick introduction on Utila for those who are unfamiliar. Utila provides fintechs, banks, and other enterprises with infrastructure to build and manage stablecoin and digital asset operations. Today, we serve more than 300 clients. We've raised more than 50 million in funding, and we help secure more than 25 billion per month in volume. Today, we're joined by, for now, 3, hopefully soon 4 industry leaders, I would say, all in their respective compliance verticals. I think we have a very well-rounded panel today spanning blockchain analytics, travel rules, security, orchestration, and operations. Just some quick housekeeping. I would say feel free to drop any sort of questions that you have in the chat throughout the session. We'll do our best to weave in the questions if it's relevant for the panel. And at the worst case, we'll make sure that we leave some time at the end to address them. So with that, if each of you wants to go around and give super quick background on yourself and your company, we can sort of get started. Michelle, you want to feel free to kick us?
Awesome. Thank you for having me. It's great to be here among such great other panelists. Michelle Latzer, nice to meet everyone. I'm the co-founder and CEO of Corsa. Corsa is a compliance operating system. We work with regulated companies that touch both rails, both traditional rails, digital assets, to really automate the entire compliance lifecycle, helping teams from scaling from onboarding through any customer reach outs, RFI management, EDD processes, through the monitoring across asset types, as well as anything regulatory facing. So we're kind of like this infrastructure backbone that integrates a lot of these different vendors and data component and enables companies to scale without the need to hire a substantial team or user engineering team to really configure all of these like logic component of compliance.
Great. I'm happy to go next. And Michelle, it's great meeting you in person last week. I'm Pelle. I'm the co-founder and CEO of Notabene. We are most known for travel rule compliance, but really what we are is a crypto native, digital asset native payment network, because that's how you implement travel rule compliance. And this is why stablecoins is also very near and dear to my heart, because we build this essentially as a way to get payment into the everyday economy using stablecoins, using tokenized money, etc. Going forward. We are not just a compliance tool. Of course, we are used very often by the compliance department, but the difference between us and many other compliance tools is that we are a network, and to be able to implement the travel rule, you essentially have to communicate. You have to send a message to an institution on the other side. And there's a lot of trust issues related to institutions within crypto, digital assets, stablecoins, interacting with other institutions on the other side. And with stablecoins, this becomes even more important, because many of these transactions start on the fiat, where they already have travel rule information, they already established practices around this, and then go on to a stablecoin native network, and then maybe out the other side as part of a fiat stablecoin sandwich onto another fiat network. So there's a lot of complexities to deal with that we're helping our customers deal with at the moment.
Okay, next. So I'm Gabi. I'm the Field CISO and Senior VP of Security at Halborn. Halborn is a cybersecurity company for the DLT and Web3 space. So at the beginning, we were a cybersecurity company for Web3 projects and so on. But nowadays, our main goal is enabling the digital transformation for the new financial system from a security point of view. So that being said, we work with not only with traditional or Web3 native clients, but also with banks, custodians, and so on. So yeah, I mean, we've seen how compliance is starting little by little to be more and more important. Nowadays, we help clients from a security perspective to be compliant with all the regulations.
All right, thanks everyone. So I guess the question just to kick us off, as stablecoin adoption scales, where do you see the biggest operational compliance and security risks emerging today for institutions?
I can kick it off. I'd say that like a lot of businesses, like, as they start either adding a stablecoin business to their existing stack, or kind of like stablecoin solutions, or organizations that before didn't used to fall under any AML obligation or any kind of regulatory like a structure. I think today kind of like the challenge that they see is that, okay, so I add like a blockchain analytics and a travel rule and then I'm done. So the challenges that we really see is like, how do you really understand your user and understand like the customer that's transacting with you in a multifaceted way across the different behavior channels, across the different assets that they are running with you, rather than just like viewing it as, multi kind of a singular rail and a singular system, which doesn't paint the full picture from a compliance and a risk perspective, especially as you want to become more proactive about the risks that you manage, rather than like, completely checking the box and being reactive to those rules that you tune. So the ability to really understand the user holistically across their different behaviors and the different signals that you get about them, I'd say it's like the most complex things for organizations adding stablecoin business, and for new stablecoin organizations that are now falling under regulation, to start monitoring and start incorporating it back to their product.
Yeah, thanks, Michelle. We see very many of the same issues, and many companies that are crypto native, they started out, maybe 5 years ago, 10 years ago, with limited compliance, limited regulation. It was just build it and let's break things and just grow our business, and that doesn't quite work when first of all, there's now pretty strong regulatory clarity globally around what you actually have to do if you're now a regulated institution. But besides you complying with your rules and with the rules that your regulator set out, you're also now in a regulated ecosystem. And I think that's a very, very big, important distinction from before, where, for example, people would say, look at KYC. KYC is just something, if you're a serious company, you'll do KYC well. Maybe there are some companies that will just kind of treat KYC as kind of a checkbox, right? And that's probably not really an option when you start integrating and performing payments at scale with more traditional regulated institutions and payment players. They're not going to really want to interact with you if this is the way that you look at it. So you now have a lot of other stakeholders besides just your regulator. Of course, your regulator is also looking at what you're doing, but in many cases, I hear that the main financial counterparts you have, or your banking infrastructure, that they are actually way stricter than the regulator are on things. So you have to completely rethink from a business level, how are you doing this? How compliance is part of your strategy? And I have a rant that I want to write, a blog post rant around the term compliance at some point, because I'm definitely someone who who was not good at following rules growing up. So it seems kind of weird that I'm kind of tangentially in the compliance space, because compliance is literally about complying with rules. But it is something where we're in a position now where we can rethink things from first principles. We can do the right thing for our customers, for our partners, and of course the regulators. And if we also start now treating the regulators as partners, and they're trying actually in many cases to be partners with the industry, we can really move things forward, start growing volume, start getting into this broader payment ecosystem where there's so much focus happening right now. But you can't do it if you're just trying to do these little checkbox. What's the least possible I can do to comply with some kind of rule? And unfortunately, you're still seeing quite a few companies in this space who are trying to get away with these kind of checkbox aspects. And I'd say the regulators should probably be the least of their worries, because their financial counterparts, the different agreement, companies that they would probably like to transact with, are not going to be overly patient on that checkbox attitude.
Yeah, definitely. So before it was just a check before the settlement, as you mentioned. But now it's, compliance should be something embedded into the flow, because embedded in the smart contract, embedded in the policy engine. Because before the question was, this payment is compliance, and nowadays is much more like this payment can be compliant before being executed. Because before, the compliance officer was just the analyst with a dashboard, and nowadays is much more like a stakeholder in the design. And you can see, I can see every day how in institutional entities, like monitoring, very, very fragmented into 5 different vendors. They don't talk to each other. Governance models, it's just a legacy from TradFi. They are not talking about upgradable contracts. When a payment is touching a bridge, for example, which is causing a lot of disasters, and or account abstraction wallet. So we can see the regulatory pressure. I'm pretty involved in Micadora and others, and I think they upgrade, or they put the bar higher. But we can say, like, in the majority of the tools are in 2019 or 2020.
I will add to what both of them said, that like we see in a lot of like businesses now supporting stablecoin that the scale happens really fast. And when scale happens fast, everything internally that connects compliance to your product breaks fast. So this is like this link operationally that we see, like either you kind of linearly have to add more team members. Obviously, you have to integrate all these different tools and vendors together. But like orchestrating this in like a harmonious way that actually is able to scale with the business and be a business enabler, rather than like everyone here, like we all say, like a check the box, and just like it can very easily slow your business and be the bottleneck for your growth. But if you set up those infrastructure rails with the right vendors and the right kind of orchestration and infrastructure from the beginning, you really are set up to be able to take on that complex, like that fast scale, without the compliance being the thing that kind of holds you back.
Thanks, Michelle. Good insights. I would say that this is a good question. Maybe. Oh, and it looks like good timing here. We have Caitlin. Maybe she could join for the next question. But I think maybe the next question is a good one for Gabi to start with. As a lot of these flows become more automated, what do you think are some of the most overlooked attack surfaces and maybe operational vulnerabilities that institutions should pay more attention to?
Yeah. So nowadays, everyone is talking about AI and so on. And recently we had a conversation. It was like, if you take a look at the April was one of the worst months in the story of crypto. It was more than 700 million stolen, and people say, oh, it was because AI, and it's partially true, because AI didn't break any piece of code. It was more social engineering. So it was part of that. So regarding this, you can see how we have new risk apart from AI, but as well as I recently read about this concept, dormant 0 days. It's AI is discovering new 0 days where like sleeping in the smart contracts and other infras, and it's quite important, the policy engine for stablecoin and other infras in crypto, because even if the code is not able to stop the attack, you have to enable a policy to be able to stop it or simulating something before. So now we are having honestly more risk in the policies, in the governance, in the oracles around, in, for example, if you configure badly an account abstraction paymaster, it could be like a huge surface of attack, as well as some predictable attacks with, as I said, like with oracles or any kind, the famous sandwich attacks in the in the mempools. So I mean, the surface, unfortunately, was is much bigger now, because all the policies and all the compliance, as we said, and I think it's like maybe the main quote for the webinar is, the compliance is not a checkbox anymore.
Yeah, I see. Like there are many companies that, particularly in DeFi projects, but also in more centralized projects, they still rely on whitelists and blacklists as compliance structures. And I think this is very risky. It's something that we could do in the past, but things are moving so much faster right now that to be able to update these white and blacklists, and I mean, I think there's nothing wrong with using them as a way of optimizing things, but you cannot rely on them as being your main compliance function when it comes to both CeFi and DeFi level transactions, because things happen way more dynamically at speed, at scale right now. And there's a lot of additional metadata that you can't get on chain as well. So of course, there's a lot of great on-chain risks and signals that you need to look at, but you now have tools through the travel rule, for example, where you have you have off-chain data to be able to help authorize and manage risk as well, which you have to do at scale.
And the piece that I have to add here is the fact that because malicious actors become more sophisticated, faster, there is a big kind of shift to you as an organization. You have to be able to look at typology, especially on the fraud side, as a more kind of zoomed out way across your portfolio, because all of these actors will do, will have behavior that doesn't necessarily trigger some of your rules and some of your preset kind of guardrails. But when you look at it from a holistic perspective, you could certainly see there's some abnormality, whether it is specific geography of significant onboarding, a specific amount or a fast kind of typology of money movement across separate actors at the same time, specific domains registrations. Like there's a lot of little things that might separately not kind of trigger any alert, any indication, any flag on the customer on the company side. But when it comes together and you kind of zoom out and see it as a group, those should alert you, and they should be more proactive to kind of stop these activity from potentially escalating very, very significantly. So this is what we are seeing as becoming really even more important. It always has been important, but now it's, across different type of typologies, not just fraud, across different asset types, like the behavior can span across rails. So yeah, I think this is something that we are really seeing now.
Yeah, and as you mentioned, for example, in the the Lazarus group, when they move the funds from running or Harmony, I mean, investigators, they were like following through dozens of hops in real time. I mean, this is technically impossible in the traditional Swift,
For sure. And Pelle, maybe a question for you. This is something that we commonly get from like financial institutions or traditional businesses who are entering the space for the first time. Like at a high level, do you mind breaking down the travel rule? What are the implications? Who's most impacted by it? And how should a business who's entering the space think about the proper implementation approach?
Sure. So the travel rule is basically, it's a payment compliance rule. It's a little known rule that has been implemented by banks, PSPs, any kind of FI really for many, many years. It's not something new. It's not something that the evil regulators invented just to like bring crypto down. It is actually something that's been around since the 90s. And the reason why most people don't know about it in traditional payments is because it was already implemented before the rules came out. The rule just set some data requirements, but if you look at a Visa message, it includes merchant and customer information. That's travel rule information, basically. If you look at a Swift message, it includes originator and beneficiary information. This is travel rule information. It's just part of a normal payment message. And that's actually why it's not so difficult for traditional FIs, fintechs, PSP to implement this, because they already know about this. It's not something completely new. They may not have heard the term travel rule before because it just works in traditional systems. So they typically don't have to deal with it. The information just feeds into their transaction monitoring and all of these different kind of tools without them knowing what it is. And that's really how you need to look at it. And when it comes to digital assets as well. So in 2019, when FATF came out with their first draft guidance, a lot of people say, "Oh, this is it's impossible." And I think there was about 120 pages in the first FATF guidelines for virtual assets, and of those, there was a page where there was a single paragraph that explained the data requirements for the travel rule for digital asset. And what you actually saw was, first of all, a lot of crypto people said, well, this is impossible. You can't do this. We cannot transmit this information on the blockchain. And of course, you do not want to put this information on the blockchain. That would be a really, really bad idea. This is private information. This is your customers' information. It's your information as well as a business. That should not live on the blockchain. And there were, unfortunately, quite a few proposals putting this on the blockchain early on. And then what we actually saw as well was that there were other institutions that were more focusing on creating box solutions that said, well, if this is what the travel rule is, let's just create a service where we can push this information to other VASPs. But they're missing the rest of the guidelines, because the guidelines is about 120 pages, and they're talking about a single paragraph within that. But you have to look at the rest of these 120 pages. What are you supposed to do with this information, right? And this is where it's just things that make sense for a business. For example, you need to be able to sanction screen your customer's counterpart. Who are they sending funds to? This is not a new rule. This is something that's always been a rule, but crypto companies didn't have a way of doing this before travel rule in the past, because we really had to rely on wallet screening for this, but it's not actually the same as doing a name screening. And doing a sanctioned name screen is a requirement. It's been a requirement for a long time, and crypto companies literally were not unable to do that. But a great thing for FIs and fintechs coming in is they already have the processes around that. It's like they're not necessarily discovering all of these additional use cases and purpose for it. So it's actually a lot easier for them than I think for many of the crypto natives who are used to just sending funds to a blockchain address. And this is also where we need to move away, I believe, from the blockchain address as being the primary identifier for payments. It's still the primary identifier for transactions on the blockchain as part of the technical engineering level, but it should not be what end users are part of. And then the travel rule gives us these tools to be able to create the same high-level trusted payment transactions that we're used to outside of blockchain use cases. So companies shouldn't look at it as like this new weird thing that they have to do, because they already deal with it in their traditional payment. So it's not something different, but it allows them to create much better payment use cases, and of course handle all the compliance issues that they need to deal with in a much better way.
And the funny thing here is now when you implement the travel rule, you are adding like a new risk. It's like the risk is not the compliance check, but what about the data leak? Because you are managing information. So because
I'll challenge you on that, Gabi. I mean, it is a new risk for a crypto company who hasn't done this before, but every single FI, every single PSP does this. The exact same thing that everyone says, oh, this is terrible, this data privacy aspect of travel rule. If you're standing with your Android or Apple phone in a shop, you're purchasing a coffee, you're literally exchanging PII and it going over this particular network the same way it is for travel rule. And it's not something new. It's not something different. Yeah. And this is also where security comes in. You need to be able to have, I stopped myself from swearing, Josh, so I will not swear on this webinar. But you need to, you need to know what you're doing. You can't just, vibe code your way to a solution here. You need to have your security stuff and you need to know what's happening. You need to work with proper partners. You need to know how your infrastructure works, right?
It was a quote to support you, not the opposite. It's like a company like yours. You provide this ciphering data end to end as well in order to don't trigger another problem. The data leak. Yeah.
The one thing I'll add to this is that operationally, it adds another layer, another data piece you have to look at, another component that you have to link back to your other operations. Another thing you have to add to your auditability and the traceability. So this is kind of like the lens by which we are looking at it. It's an added complexity for those companies, which they inevitably have to do. But now their operations are becoming, just more complex and, just as, if not more than any traditional FI.
For sure. And Michelle, sorry, Pelle.
Yeah, I was just going to say, it does add a whole new level of complexities, but we also have some superpowers on the crypto side, on the digital asset side. We have public blockchains, right?
Right.
They are impeccably traceable. They are amazing. They are fantastic. They're way better at tracing what happened after the fact than any traditional payment system or financial system. And that's amazing. That together with kind of next generation compliance tools, next generation payment messaging tools actually provides much better, much safer payment, payment systems than what we've had in the past. Where in the past, many of the traditional payment systems, they'll just rely on we'll just refund the funds if something goes wrong, right? Because, we can't be bothered doing a protocol upgrade to fix some particular issue, right? That's just how things work in traditional payments, right? We have got amazing tools, but there's a lot to do. right? But with the tools, and that, like a lot of the tools that you guys are working on Michelle, what we are doing, and you guys, Gabi, as well, is making it, it's something we can do, right? It's not this terrible thing where we're like, oh my God, what are we going to do? There's no way we can deal with it. There are actually really great solutions now. We can build much better solutions than what happens in the traditional payment ecosystem.
Thanks. And yeah, I was gonna, for the next question, just start with Michelle, because you alluded to this a little bit before in one of your answers. But for many companies, this is their first time processing, maybe transitioning from, say, doing millions of fiat transactions to now doing millions of monthly transactions on chain. And as part of that, in sort of how on-chain compliance works, you can be very quickly overwhelmed with a number of alerts, right? And for firms who are entering this for the first time, they experience what some call like alert fatigue. So I guess, what advice would you have to firms to help sort of manage the sort of alert fatigue and also these false positives at scale?
There are two components to alert fatigue that we should discuss. The first is obviously you need to create rules that are fine-tuned to the risk that your business is facing. Every business, every regulated business is different. It's different in the risk appetite. It's different in the customers they serve, and the products they serve, the geographies they serve. And that leads to very specific risk vectors that can affect them. And if you are able to really understand your underlying business and have the right infrastructure and tooling to be able to translate that into rules that capture those risks, you shouldn't be bombarded. You shouldn't be scaling your alerts as you scale, linearly as your business scales. You need to kind of always be monitoring for the performance of them to understand that they're capturing what they should be capturing, and they're obviously not spamming your inbox and your team's inbox. The second component is, once an alert was triggered, rightfully so, is really be able to analyze it fast, to understand it in the context of the user. Even if an alert from the on-chain component was triggered for something that doesn't look so severe, maybe together with the rest of the behavior of this user, this could be something that you should be looking at, or you should be investigating deeper. And these are the areas that really that us as a business really are focused on, understanding the full context of your business and helping you automate a lot of this context. A lot of remaining consistent is another issue with alerts kind of handling, especially as you have compliance officers can change often, and really making sure that your organizational policies, procedure, risk appetite are translated to the actual day-to-day operation is something that is very important. And of course, AI can really help us be this kind of guardrail for that. Understanding how we've treated similar alerts before, what was the outcome before, looking more holistically at a user and the different kind of signals that come from it, and eventually bringing all this important data to the compliance analyst or officer to make this judgment call, should this be escalated or not. But really cutting 90% of the more mundane work of gathering the data, analyzing the data, for them to giving them all this information, evidence, and kind of citations of where this was taken from, and letting them make that judgment call, agree, disagree with the agent's decision. But cutting that element of fatigue, which comes from a lot of that manual element of understanding what's going on, right? What the hell is going on here? But to summarize, it all starts with refining rules to make sure the rules are fit for purpose for your business. That the false positive ratio is correct. Always keeping kind of one hand on the pulse there across your different vendors that are alerting you, sending you flags, and then implementing the right automations in process to help you triage them consistently and more sharply.
So you definitely spot on, because it's the problems. The problem is not the false positive. The problem is we are looking for the wrong pattern, because the framework, the mental framework for the majority of the industry is they come from traditional AML, looking for transactions seems suspicious. But in on-chain, it's exactly the opposite. So if you check the hack of the Radiant Capital, the malicious transaction was identical, was the same of the 50 transactions before. I mean, it was legit, but which was not legit is the context. I mean, who changed the implementation of the proxy more or less 50 seconds before? Which kind of admin slot change? Which functions have new permissions? So it's we were monitoring, or most of the companies, they are monitoring flows, when the thing we should monitor is the state, because it's for that false positive are generated, because the rules, they are checking the wrong thing.
Cool. And Gabi, maybe sticking with you for the next one, we haven't touched, I think, as much on incident response, which I know is one of Halborn's areas of expertise. How do you think, or like, what advice would you have for organizations in terms of thinking about incident response, operational resilience when building their technology stack?
So I think that the first point is, in crypto, in digital assets, incident response starts before the incident, not after, because is when you click on the payment, the money, we usually say the money is gone. So in traditional finance, incident response is more a reactive process, like you detect, you content, you eliminate, you recover. But in on-chain, this model doesn't work, because when you detect, maybe funds are already in a mixer, or they are crossing a bridge. So the goal of the settlement, convert this containment phase, is just it's something like a hallucination or something like that. So it's for that the real incident response in crypto is the pre-incident. So you simulate the attack before this happened, and you should define these kill switches in the smart contract itself. You have to have like a signature before that with the exchanges, and bridges for the emergency freeze. For example, there is a case, remember Euler, I think they lost 200 million, and they recovered them, not for a brilliant incident response, because they trade with the attacker, and maybe this is not incident response, this is something desperate, like negotiated with the attacker. But the mature, let's say, the mature incident response assumes that the reactive response is going to fail. So you have to put the controls before that. But obviously, you have to have an incident response playbook if something happened, to try to reduce the loss. But I think everything happened before, in my opinion.
I mean, in slightly different use cases, not necessarily the ones you're talking about here, Gabi, because this is like all hands on deck on these kinds of exploits. But for a lot of different fraud type use cases, they're like having a messaging system between trusted institutions allows you to do things that the crypto industry thought was impossible. So, for example, we have a revert functionality that that it's a message. It's not like we're not reverting funds, but and that's also not how reversal works within a Visa network either. It's a message between institutions where it could actually be either side of the transaction who, for some risk or fraud or whatever purpose, they are requesting a reversal of a transaction, and doing it in a safe way. Obviously, this is not gonna necessarily help you if someone's draining a smart contract and feeding it through a bridge or mixer. But for many of the other kinds of fraud use cases, we do now have some of these constructs that are common in traditional payments as well for companies. But these require trust. These require messaging. This is not something you do on chain. It works because they're regulated institutions who want to be trusted and be trustworthy, who participate in these networks.
Yeah, it's the concept of the golden hour, right? In traditional finance, is the first 24 hours are essential. In crypto, maybe golden hour is the first 90 seconds, maybe. So because it's the time maybe an attacker is able to move funds through a bridge or something. So maybe if you you're spot on, because you need to make things more automatic. So if you want to pre-authorize this kind of automation, but you have to put this without a human approve. And this is completely against a compliance officer from the traditional finance or traditional banks, when make things automatic without human oversight is like, it's completely against everything. But in crypto, maybe this kind of human oversight is the time to lose the funds. So maybe the oversight, as I mentioned, maybe it's in the policy and not in the execution.
Yeah, I mean, there has to be ways to flag things. I mean, obviously, you want to automate as much as possible, and you're not, like, if your Visa or MasterCard transactions on there, if they are all being manually reviewed, that's not a good business for anyone involved. But it is all about policy-based automations. A lot of the different tools we're all building on that particular front, and then having humans intervene when needed on that. And that's a little bit trickier, but I still think it is possible with smart contracts. I don't think it's impossible to do that at all.
Thanks. So I want to get to, it looks like there's one question from Aaron Chen. Thanks for asking. And by the way, feel free as we come towards the end here to post any questions from the audience in the comment section. The question from Aaron, curious how folks on the panel are thinking about MTL licensing as stablecoins move further into payments infrastructure, especially for companies operating across multiple states. Is the regulatory patchwork something you're seeing teams actually build around, or mostly outsourcing to counsel? It's a good question. Feel free, if anyone has any thoughts or answers, to just chime in.
Becoming an MTL regulated company it's a big undertaking for a company. Something that is that requires a lot, and we see a lot of teams starting out with a licensed partner as kind of the first phase and a phased approach to it. At which point they already implement a lot of these compliance guardrails and operations in place, even though they're not directly the licensed entity. They are relying on another licensed partner. But at the end of the day, where we see the shift and the movement is definitely towards acquiring more licenses, whether it's MTLs across states or whether it is also multi-geo and internationally, kind of being able to facilitate those payments cross-border. It's certainly the movement that we've been seeing. But I would say that, like, before you acquire certain licenses at a certain geo, definitely like working with regulated partners is what we see as phase one, and what we've seen as kind of like the growth. And it doesn't take away from your obligations. If anything, it's kind of like your phase as creating that, because it's a big shift in an organization moving from like the unregulated side to the regulated side, for all the various reasons we just discussed for the last 40 minutes. And becoming an MTL license it comes with its burdens, but it's a significant moat that, and significant kind of technical and kind of regulatory dependency that a lot of those businesses are now relying on. So whether a lot of them start with outside counsel, eventually very fast starting to add that in-house. So yeah, this is like my 2 cents of what we've been seeing.
Yeah, I'm not directly typically involved with that level, and normally we're not working that much with our customers on that particular side. But I do know, and I do hear from a lot of CEOs and CCOs that it is a very expensive process to deal with. So I do agree with Michelle. Like probably most people starting out, they outsource as much of that as possible. But it's also something that I don't think you can outsource forever. You really need to turn this into a strategic part of your business. We're seeing it in a slightly different way with a lot of the US neobanks that weren't really neobanks because they were, using banking as a service companies before. Many of them are now taking the steps to actually own their own destiny by getting their own banking licenses with OFAC. Not with OFAC, sorry, with
The OCC.
Yeah, OCC, yeah. Yeah, you do not want a license from the OFAC, yeah.
It looks like people are trying to avoid it instead of implementing.
Yeah, I guess another question. So I think at this point, the promise of stablecoins is clear, right? It's 24/7 payments, instant settlement, et cetera. But compliance doesn't always operate, say, at the speed of the internet. And inevitably, you see some level of friction that comes between your regulatory and compliance obligations and a more frictionless, say, user experience. In practice, how should businesses think about this sort of balance between like a seamless, frictionless user experience and also their compliance obligations?
This is a pet subject of mine, if I'm allowed to start on this. So we heard a lot in the early days of Notabene, travel rule just creates a ton of friction, right? But I also just want to call out that we are an industry where we, for the last 15 years, have decided that customers copying and pasting in very, very long, encrypted, well, not really encrypted, but hashed strings into emails and copying them, pasting them into withdrawal screens is good UX. That's what that's what we started out with, right? At this industry. That's not what people from outside of our industry is used to. And I jokingly say that that the crypto industry itself, and this is different from the whole new group of payment companies and stablecoin native companies coming in, but the traditional crypto companies and many early stablecoin companies, we have a little bit of a Stockholm syndrome towards bad UX and dangerous UX around the blockchain address, right? And start having other constructs around sending funds to people, sending funds to businesses, requesting funds. These are much more natural constructs that allow you to build much better UX, much safer UX that people are happy to use. And I've been as I mentioned before, I've been involved with crypto with Bitcoin since 2010 and part of the old cypherpunk movement. I know what happens. I understand everything about it. Maybe this is also why I'm freaked out. I do not use my MetaMask to send stablecoin if I'm moving money. I'm using Weiss, and it's because it's much better UX, or I use my bank. Crypto stablecoins provide terrible UX, unless this is the main thing that you're used to, right? But having new constructs like the travel rule allows you to build much better payment UX for your customers that are also then faster to process, faster to deal with on the compliance side, and overall better and safer.
I can answer more zoomed out from my perspective. I'd say I'll start by saying that real-time monitoring is vital. Like, let's start with that. But then, besides the things that are absolutely needed and required by the regulator, there is some sort of like a decision to be made, or a line to walk around kind of the compliance requirements and the things that you want to collect from the user versus like the UX that you want to give them. And here comes to play like the organization risk appetite. the organization use cases, like what type, are you an institutional player? Do you support retail clients? Are your transactions generally very large? Are they very small? All of these things can come into effect, and can come into effect in a matter of like a phased approach to how much information you request, to how much data you actually need to assess the risk. But again, it all boils down to really understanding risk in real time when it happens, and then acting on your risk appetite. If it's low risk according to your risk appetite, you might not need as much from the user at that moment in order to make it proceed. But it only comes when you have clarity around the user. Who's the user, like their transaction, their behavior across different channels where they behave on your platform. And then you can really be more in control and say, okay, at this point, I feel like I have enough information to let this through, or at this point, I feel like this is something that would require this like next phased approach, and we should reach out to the client. So these are kind of the kind of more zoomed out way that we're looking at. And I'll add to that like a lot of these RFI and reaching out to the client for additional information. A lot of the time we see that because teams are large, they're scaling fast, a lot of transactions, you end up asking clients for similar things in a short span of time that you actually asked them already a few months ago. These are a lot of things that you can also obviously eliminate with automation, with kind of seeing everything holistically together. So we focus on that a lot, kind of how to improve UX, so kind of not bother the client as much while still making sure you have the information you need, even if you did deem that you actually need to reach out to receive this information. So definitely something we are very focused on and see a lot of clients very, very focused on as well.
So what I see is just I think nowadays UX and compliance, they are not opposite at all, because they are measuring the same thing but from different angles. Because a bad UX in payments, it's like unnecessary friction and unpredictable latency and steps the user doesn't understand. And bad compliance is the same, because it's like redundant controls, you add more latency and so on. So when a user leaves a payment because should pass through 3 different verification and so on, this is a very bad, this is a fail in the UX and a fail in the compliance at the same time. Because if you have a control which trigger the user wants to avoid, is not it's not a real control, because at some point it's like the user should be like a hidden compliance, like checks they are running in parallel, but the user doesn't realize, and their decisions, they are justify themselves, and they are check like it's just a friction when a very risk you have a signal of risk. So this is the real convergence, because the idea of compliance is the price we have to pay for UX. I mean, this is maybe a pre-on-chain era. So in 2026, I think compliance, a good compliance is a good UX. So if the teams they are saying is still like something opposite, I think they are losing on both sides. This is my point of view out of the building things and so on.
For sure. Totally agree. It looks like we're getting towards the end here. So maybe just if each of you want to give maybe one piece of advice, one final takeaway for the audience that you want to leave them with, or maybe just anything else relevant. Michelle, if you want to get started, and then Pelle, and then Gabi, you can close us out.
I will say that traditionally, a lot of teams have all of these different logic components that we all discussed here. Like when that happened, do you stop a user? Do you freeze a user? Do you lower their tiers? Traditionally, all those generally teams build this logic layer internally. And the reason that it's hard when it scales is because then you have to go back and redo, using your engineering team to redo this logic component whenever you want to swap a vendor, to add a vendor, whenever you're entering a new geography. Whenever operational complexity increase, these internal systems really suffer. And what we've seen is obviously, like, we are an AI native tool. Every company realizes the benefits that can bring to their operations. But there's a really, again, like, nuanced way in which you want to integrate AI into your processes in a way the regulator still approves it, that provides the right traceability of decisions, and that lets you automate it to the max without with putting the human in the loop at those critical moments. That, again, we see teams like trying to experiment building internally, but there are a lot of complexity around both the actual agents, kind of under the hood. Which model are you using? What kind of temperature checks are you having on them? What's the security guardrails that you have? At the end of the day, this is PII information, data protection, especially if you touch any European data. So all of these, like, added layer of complexity is what eventually teams that have started building in-house and adding AI, like, kind of are being deterred or looking elsewhere, and where we found, like, the biggest value add that we provide. So whenever this, like, moments arrive of something happens and we need to redo our internal systems, this is, like, the area that interests us the most. And what we basically tell teams, like, don't spend your time and efforts and energy and money on, and whereas, you can essentially get the most bespoke level of operations out of the box.
Yeah, I agree generally with what Michelle says. A lot of these systems are not things you should be building yourself. And when it comes to travel rule, for example, it is not something you can build yourself. You can integrate with a travel rule system, but travel rules it relies on a network. And the network is not something that you can just build into. And as an example, when we're looking at a lot of the companies in the stablecoin space, they're doing technical integrations with different fiat providers to be able to expand their network. That is what you would have to do in a travel rule system if you try to build things yourself. And there are some companies that are trying to promote this way of doing business, but we think of it, look at this as a business level. It's something that you need to take on from the business point of view. Compliance teams need to help drive it, but it's also something that the business really needs to drive and be aware of, because it's directly related to who you can transact with. It's directly related to revenue going forward. So don't try to build it on your own. Don't treat it as a checkbox, because you will fail. Maybe in the short term it's great and cheap, but you will fail when you start transacting at scale.
Yeah. So my takeaway here is even you have to audit the smart contracts and audit, to avoid any exploit. So the next major failure in stablecoin payments is not gonna be it's not gonna come from a cryptographic exploit or a smart contract, but it's going to come from a poorly managed admin key, multi-sig signer who approve without reading the thing, the blind signing, or a vendor integration nobody audited after day one. So stablecoin security in 2026 is not a cryptography problem. It's operational governance problem. And most institutions, they are still treating it as if it's the first one. So auditing the contract is necessary, is mandatory, but you have also to audit who can touch that contract, how, when, and under what circumstances. So that's where the real work is.
All right, that brings us to 12:01. Thanks to all the panelists for joining. Appreciate the insights and for you being here with us. Thanks to the audience as well, even though we can't see you. We appreciate your time. And yeah, I hope everyone has a good week ahead.
Thanks,
Thanks,
Josh.
everyone.
Thanks, everyone.
Thank you.
Thanks.